So while we're sorting out the presentation, my name is Hugh Chung. I look after the investment office at Endowus. The investment office curates funds as well as builds portfolios for clients such as yourself. Endowus, as you see, is a conflict-free wealth management platforms. We go through evidence-based advice, institutional access, and low fair fees. As you can see from the names at the bottom, Endowus employees are actually the largest shareholder of Endowus. But then we have prominent shareholders such as UBS, Citi, MUFG, EDBI, which is the Singapore government, as well as other prominent shareholders in our cap table. Next page. So there are three real pillars at Endowus, which is advice, access, and cost. So the first thing is advice. So if you look at, I know it's a little bit difficult to look at this chart right now, but the main thing to take away here is that when someone thinks about advice, they would normally look at the page on the right. They will give you some allocation of assets, equities, fixed income, etc., and say, this is your allocation. What we do is we start from goals. So we look at your goals, whether they're short-term, long-term, mid-term, what are you looking for over a certain period of time? So we work from the goals, and then from that goal, we work into what is the best way to achieve that goal, and that is our kind of crux of the advisory that we provide. Next page. So we work with the second pillar, which is access. We work with a lot of institutional fund manager partners, such as Invesco, as well as Capital Group, as well as PineBridge, that are here today with me, but many, many others as well, including both in mutual funds, as well as private markets and hedge funds. Next page. The third value proposition for Endowus is fees. So as you know, fees are one of the very few things that you can control over the long-term wealth accumulation. The chart below shows you that a very small change in fees makes a very big difference on a long-term basis. One of the big differences between Endowus as a platform and other fund distributing platforms and banks is that we charge a fee on your invested assets as opposed to getting commissions on the sales or trailer fees and so on. So it is really that alignment that not only drives the costs, but the advisory part, because the team that I look after actually is completely agnostic to what brand name or what commissions we generate. It's really based on the most, the best fit for your client. Next page. So what Endow Us means is it's endowment investing for all of us. So it's giving individuals the same access and advisory and cost that an endowment or an institutional agency would get. Next page. So with that, without further ado, let me introduce our panel speakers on the stage. Andrew Lee, Investment Director at Capital Group. Chris Hamilton, Head of Client Solutions Asia at Invesco. And Andy Swen, Managing Director and Co-Head of Asia Fixed Income, PineBridge. Actually, he says it's better. Suit me. Thank you. Maybe we could start. So the way it's going to work, I know we don't have a lot of time. So there's a few kind of pre-prepared questions on the rate cut that we're going to go through. And I'm hoping that you guys will make it punchy, maybe 2 minutes for every question. We have a lot to go through. But before that, maybe we can spend a little bit of time, just a quick intro, maybe starting from Andy, of who you are, who you represent.
Sure. Good evening, everyone. I'm a portfolio manager from PineBridge. I specialize in Asia fixed income, covering the Asia investment grade as well as high yield market. So been with the industry for the last 16 years.
Thank you. Chris?
Hi, I'm Chris Hamilton with Invesco. I lead our multi-asset and systematic investment capability in Asia Pacific. So anything that's multi-asset, systematic in nature, we invest across public and private, as well as leverage strategic and tactical asset allocation. So very macro-driven.
Andrew?
Well, hi everyone. I'm Andrew Lee. I'm investment director from Capital Group. I think I'm going to be slightly different. I'm just going to spend perhaps 30 seconds on Capital Group. We started all the way back in 1931, so I have more than 90 years of investment experience across global equities, fixed income, multi-asset, and currently we manage around 2.7 trillion assets across these asset classes, which also means that we are one of the largest active asset managers in the world.
Thank you. So the topic today, as everyone knows, is that there will most certainly be a rate cut, our first rate cut in September next week. And so the question that everyone is asking is, how do you position portfolios, if at all, going into this rate cut cycle? So we have experts in multi-asset and equities and fixed income all represented here. So I think it's going to be an excellent session. Maybe if I can start off with Andrew. Obviously, not just the first half of this year, but throughout last year, a lot of the performance has been driven by developed market equities. So, and within that, obviously, there's been a lot of like US exceptionalism. There's tech, Magnificent Seven has been really driving it, right? So maybe I'll go through it first. How do you think about the macro backdrop for equities in general, but also kind of US equities and this developed market piece going into this rate cut cycle?
Okay. I can use either way.
Yeah, so this is going to go for recording, but just think about, this is the main mic.
Well, first of all, thank you so much for having me. Really excited to be here. I see some familiar faces in the audience, so that makes it even more exciting. So I think you mentioned about US exceptionalism, the big tech companies. I think I'll just start off from there. I think, it's helpful to take a step back and understand why there is this US exceptionalism or US leadership if we look at over the last 10 years. So what has happened is that US corporates over the last 10 years have been growing their earnings very sustainably and consistently. We're talking around about 6% annualized in terms of their earnings growth, and that's a lot higher compared to the other parts of the world. If you look at Europe, we're talking about earnings growth around half of that, around 3%. If you look at emerging markets, it's actually growing in a negative trend. We're talking about negative 1.6% in terms of earnings growth. So the fact that US corporates manage to grow their earnings at a superior level, plus the fact that there is good level of economic growth in the US, markets reward US companies with multiple expansion as well. And so if you look at Japan, for instance, in comparison, Japan's earnings growth is actually not too bad over the last 10 years. We're talking about around 4%. But as we all know, Japan's been going through structural challenges in terms of economic growth. There is also a deflation pressure there. So they didn't really enjoy that multiple expansion. So whether US exceptionalism, whether US leadership can continue or not, I think would ultimately depend on whether US corporates can continue to grow at that, in terms of profit, continue to grow at that superior rate consistently, but also whether other parts of the world can play catch up. And then I think similar logic can be applied to the big tech companies as well. The reason why these big tech companies continue to be bigger and bigger is largely because they can grow their earnings at a superior rate for an extended period of time, because they have really strong balance sheet, because they have really leading edge innovation, because they do have really strong moat, but also I would say that they're also doing very well in their own respective industries. And I think one thing that I do want to highlight is the fact that for these big tech companies, especially if you think about those Mag 7 or related to AI, these companies are operating in a winner takes all or winner takes most industry dynamics, which is very different compared to other sectors, which means that they can really leverage on those growth levers to grow bigger and bigger. And so I know that I probably spent that 2 minutes already, but to get to your question, it's whether how do we see this? We think that don't count the US out, don't count the big tech out yet, because there are fundamental reasons to be excited about these two segments of the market. But at the same time, as we look at the latest earnings seasons, earnings are broadening out from US to other parts of the world, from IT to other parts of the sectors. So be diversified, focusing on companies that are fundamentally attractive would be how we think about that. Plus, there is a rate cut cycle coming through. Just broadly speaking, I think that would also set up equities quite well going forward.
Okay, so you seem to be still quite, I guess, constructive on equities going into the rate cut cycle. Maybe I'll move on to Chris, and because you're, I would say, a little bit more balanced, being multi-asset, and I'm going to go to fixed income in a minute. Like, just as an extension, maybe you can share your macro view as well. But like, how do you balance between equities and fixed income going into this rate cut cycle?
Absolutely, great question. So let's, I think Andrew did a really good job at talking about some of these secular drivers we've seen coming out of the U.S. over the last few years. I'll start in May of 2023. So we've obviously had this AI-driven M7 trade come into play. And if you look at something like the Herfindahl Index, which measures equity market concentration, it's essentially gone parabolic in the U.S. over the last 18 months. So it's essentially a strong bull market that's been driven by a handful of stocks. It's very unique. It very much rhymes with what you saw in the tech bubble in 1998, 1999. All the while, you had increasing growth expectations in the U.S. You had a pretty buoyant economy and the like. Inflation, has been largely mitigated. So in the first half of the year, we were very much risk on. In July, that's really where we started to see some of these cracks come through, particularly out of the US. If you look at something like the City Economic Surprise Index, it's actually been negative in the US for quite some time now. So the data release isn't meeting expectations. We think that, along with several other data points to weakening in the economy. So from June into July, we de-risked our portfolio. Now, because we're investing across equities and bonds, we're tracking error sensitive, so we don't make big wholesale changes. The biggest difference from June into July is that we do have a preference for fixed income. We also have a preference for quality credit and extending duration. So that's a big shift. So even going into a Fed rate cut, why is the Fed cutting rates? Because the inflation problem has largely been solved for now. It is a long-term risk. And there's economic deceleration coming out of the US, so that's why we're doing it. So we're more focused on that piece, and that's why we've done some of that de-risking and why we have a bit of a preference towards quality assets on the equity and fixed income side, and using duration as a diversifier in the event there is an economic contraction.
Yeah, so a bit more quality, defensive, longer duration. So with that, maybe going to Andy, I mean, historically, in a rate cut cycle, it seems like at least every time bonds outperform cash, while I think the equity variance is a little bit larger. So how should we think about fixed income? Is it going to be the same time this time? And within fixed income, is there a particular segment that looks more attractive? I think Chris just said longer duration, but what do you think?
Sure. So yeah, I think you touched a key point. So historically, in a rate cut cycle, so fixed income tend to outperform cash. And if we look at the past 3 years, fixed income has underperformed almost everything, like underperformed cash, underperformed equity. But now I think we finally can claim that we reached an inflection point in terms of monetary policy. Next week, it's quite clear the rate cut will start. We in the camp that probably is just 25 bips cut this time, and the pace of rate cut probably wouldn't be as aggressive as what's being priced in the market right now. But what's more important is that I think the direction of travel is very clear. If we look at the inflation data points, is settling at stabilizing at low 2%, and the growth data points, whether it's consumption, employment, is suggesting the U.S. shifting to a slower growth mode. So we are not in the camp of recession, but even in a soft landing scenario, we do think there's quite a bit of room for the Fed to cut rates from all the way from right now it's at 5.5%. Assuming if inflation is settling at low 2% area, we think terminal rates will probably be end up at like low 3%. And that would be quite positive for fixed income in general. In particular, we would prefer the shorter end of the fixed income market, meaning that the 3 to 5 year part of the market. That part will be sensitive to the coming rate cuts. We don't have a very high conviction on the longer end. We think the 10-year right now at 3.6% area is probably close to fair value, unless there's a major recession in the US. In terms of overall attractiveness of the asset class, I think right now it doesn't make sense for investors to add allocation. Bonds is generating income, and at this juncture potentially provide capital upside as well. And I think as Chris mentioned, this diversification play could serve as a hedge over other risk exposure as well.
Okay, maybe with that thought, I think maybe shifting gears a little bit because I think all of you, it seems like there is an assumption that there's not going to be a massive recession, right? Would that be fair? That's fair, right?
Yeah.
So, and I'll go to that in a minute, but then which means that actually equities should also be okay, right? Depending on which segment. So maybe diving deeper into equities a little bit, because I didn't give you enough chance in your earlier time. I mean, would there be a specific area within equities that you would be a little bit more constructive on? You were talking about Max 7 versus the rest of the world, but I mean, is there a bigger reason to diversify out of the US? And then by sector, is there a reason to be a little bit more constructive on, non-tech sectors, and then within large cap, small cap, is there like a, different kind of space that you would be overweight, for example?
Yeah, sure.
Maybe I can,
Thank you. Before going to the questions, just very quickly in terms of how we think about recession
yeah.
or the economic outlooks, primarily in the US, I think what's very interesting and very important to note is that if we look at the US economic or business cycle at this point in time, I think we're starting to see the path where the cycle is going from late cycle to mid cycle, which is quite interesting to think about. I don't know whether there are any movie junkies here in the room, but if there are, I don't know whether you've watched the movie called The Curious Case of Benjamin Button. Okay, so there are some nods there, great. For those that haven't watched this movie, essentially it orients around the main character, Benjamin Button, ages in reverse. So born old, but ending his life as a baby. So I think the US economic cycle right now is following that pathway. A couple of reasons for that. If you look at, for instance, output gap, typically in the late cycle, we see positive output gap, and that peaked for an extended period of time. We're not there yet. Secondly, if you look at the cost and price inflation is slowing, which is the opposite direction of what a typical late cycle would be. And if we look at profit margins, right now we're not in a contractionary phase, we're actually growing. And so again, that's a signal more towards a mid-cycle. And then also if we look at the fourth element, the finance gap, which measures the difference between CapEx and also cash flow, right now we're not seeing that narrowed. So again, it's sort of pointing to the signs that we're in a mid-cycle, plus the fact that monetary policy, yes, we're probably going to see, most probably going to see a rate cut coming through, but I think our thinking is still that over the medium term, we're probably going to see a neutral stance on policy rates rather than a broad, easy monetary policy stance. So I think all this points to the fact that if we're really going into the mid-cycle recession, it's actually, or recession going into the end of this year, also going into the next year is not something that is my base case. So in terms of how we think about the equity markets, to my answer earlier on to your first question, I think the earnings broadening out from US to other parts of the markets, and also on a sectoral level, broadening out from IT to other parts of the industries, I think makes us really excited about finding companies through a bottom-up lens in other parts of the in non-US, in also non-tech. But ultimately, I think it's very important to sort of bring across as a concept that it's never helpful from an investment standpoint or from a portfolio construction standpoint to have all these very rigid binary definitions, meaning that it's not necessarily or, it can be and. So in your portfolio, I think it's really crucial to think about whether it makes more sense to have US and non-US, to have tech and non-tech, to have value and growth. And so I think across the board in our global equity portfolios, we are essentially very diversified across all the sectors, IT, healthcare, largely because AI as well as healthcare innovations are some of the secular growth trends that we're really excited about. But we're also finding opportunities in some of the older economy sectors, such as financials, industrials, that are benefiting from renewable energy transition or reconfiguration of supply chains. So ultimately, it's really down to the company fundamentals and finding the right companies across the entire opportunity set.
Okay, that's very helpful. Maybe I'm gonna kind of dwell on that recession question a little bit more, because you were saying that your portfolios are becoming a little more defensive. So what's the risk that we do get into a harder landing recessionary scenario? And then even in that scenario, would you recommend to our clients to stay in cash? Or would you say it's still better to be invested? You're just invested in more defensive stuff or what have you?
So I'll answer your second question first. We always remain fully invested, regardless of cycle. And because we have the option to go between stocks and bonds, it gives us a lot of flexibility. We don't have a module where we go to cash. If we want to be defensive, we're adding quality, we're extending duration. If we want to take risk, we're adding cyclicals, we're adding credit sensitive exposure. So we don't have a module to go to cash. I mean, we do stay fully invested. We are benchmark relative investors, so it doesn't behoove us to make very large swings in asset allocation because I think we've seen the evidence over time, risk assets and beta has a tendency to work. It's very, very hard to time the market, so because of that, we're gonna stay fully invested. The question about a recession, so we're not so much as concerned about a recession is defined as 2 consecutive quarters of negative GDP growth. We're really worried about the rate of change in growth and deceleration. And that's why we went into more of a defensive mode. You can go into that mode and not actually experience a true recession. It's happened before. So our base case is somewhere in between a soft landing and maybe a light recession in the US. The risk we're probably most concerned about, and I alluded to this in my last question, is the Fed getting way out in front and cutting rates aggressively and then seeing a re-acceleration of inflation, where they then have to stop the rate cutting or, God forbid, increase rates again, and you basically create a 2022 all over again. We think the probability of that is low, but that's probably I'd say the kind of tail scenario we're most worried about as opposed to a very cataclysmic recession.
That's very interesting. I mean, I'd like to hear your thoughts about that, Andy, too. But since you're an expert in Asian fixed income, maybe along with the overall fixed income analogy that we had, I mean, how does Asian fixed income, do you think, sit within that spectrum? Because I think like now developed market fixed income and treasury and whatever are seemingly very attractive, people are like, why bother with Asian fixed income? So like how would you kind of think about that argument?
Sure. So just on the point of recession first, so our base case is a soft landing scenario, but we're also mindful that like every recession starts looking like a soft landing first. So we don't rule out that possibility of a recession, even though that we think the probability is we are signing it at like 20-25% area. But I think the good thing about buying bonds at this juncture is that whether it's a soft landing or recession, even if it's a recession, then the Fed has to cut rates very aggressively, and that would help bond performance. But even if it's a soft landing scenario, Fed fund rates at 5.5% is very, very restrictive, and compared to the 2.5% inflation, the real rates, talking about like 3%. So even under soft landing scenario, we think there's still ample room for the Fed to cut rates, and that would help fixed income products, particularly I would say at a shorter end. So, my comment so far is focusing on the treasury market, more like a risk-free product. But we do think there's room to add credit risk at this juncture because look at the corporate fundamentals, whether it's in high yield investment grade, particularly in Asia, I would say, the investment grade companies have been maintaining a very low leverage compared to the developed market investment grade, which is talking about net leverage of 1.5 times area compared to same rated investment grade companies in the US or Europe. And the macro backdrop here, excluding China, I would say, looks much healthier than the developed market at this juncture. We are seeing more rating upgrade than downgrade in Asia ex-China investment grade, whether it's the past 1 year or the past 3 years. So we do like Asia investment grade in particular. And the duration profile Asia investment grade is around 4 to 5 years, and that fit into our preference in terms of the duration profile in the fixed income market as well. The high yield market, if you look at a credit spread globally among all the major credit markets, almost every single credit market, the credit spread is trading at a tighter end of a historical trading range. Asian high yield is the only one exception. And the reason because of this, I think many of the audience know what has happened to the China property sector. It has a wave of default and that crisis is not ending yet. And we think the negative sentiment towards the China property market because of the defaults is unfairly affecting the rest of the Asian high yield market. If we look at the Asian high yield market excluding China property, the default rate is lower than the US high yield market, for example. Year to date is running at like 0.5% area. The US high yield market is running at over 2% default rates. And credit spread is wider than the US high yield market. And the duration profile is also 2 to 3 years, and that fit into our preference in terms of duration as well. So we do like Asian fixed income, both investment grade and high yield. Yeah.
Okay, so in order to make the mic transfer a little bit easier, I'm going to go to Chris. And I'm going to go to everyone's favorite topic, which is US elections.
They get to go first because I'm an American.
Yes.
Is that why I get asked first?
No, I mean, nothing sensitive, obviously, but I just wanted to know, how, if anything, should investors think about with regards to their portfolios going into elections? Any insights you could add?
Most definitely. So I think it's always important to kind of couch the historical observations we've seen from elections and how, if any, effect they've had on market returns. And if you go back to 1968, the election of Richard Nixon, every single presidential administration, with the exception of 2, the average return of the S&P 500 has been above 10%. So it's always important to kind of put that in context. I know elections, are on the television a lot. I think the best thing you can do is probably turn the TV off. That's what I do. And specific to this election, we actually don't think, regardless of who wins, Vice President Harris or President Trump, there's going to be a big impact on the markets in the near term. We had an interesting, back and forth dialogue with one of our market strategists last week because the question comes up around China a lot. Yeah. And her view is actually there is a positive upside possibility of, I think, a more negotiated deal environment under a potential Trump administration. Now, we're apolitical, we don't take sides. I thought that was an interesting observation. So I think our big takeaway is it's kind of, no news is good news. We don't see big changes or shifts with respect to this election. And just thinking about it historically, it hasn't really been a big driver over the long term, although it makes really interesting television.
Okay, so just to give a more balanced view as well, maybe I'll hand it to a non-American. Are you American?
I thought my view was pretty balanced.
Okay, non-American. Whoever wants to take that question. Maybe Andrew can take it.
Okay.
I guess just from an impact on international equities, Chinese equities, is there anything people should be thinking about? Tariffs, inflation, anything?
I think as investors, we should think about it. Should we act on it in the next 53 or 54 days before the actual US election? Not necessarily. Chris just gave some really great data all the way back to 1960s. And if I can, I'm going to give you another data point that goes all the way back to 1928. So since 1928, S&P 500 have been through 23 election years. Out of those 23 election years, 19 election years had a positive returns. There are only 4 years that S&P 500 locked in negative calendar year returns. And those are 1932, 1940, 2000, and 2008. And there's one common thread that sort of linked these 4 years together. Not necessarily, actually irrelevant to who ended up took the office. It's actually a macro shock that happened during those 4 years. So 1932 and 1940, we were talking about World War and also Great Depression. In 2000, we were talking about the dot-com bubble burst. And also 2008 is the GFC. And so I think that sort of give perspective to that if history is something to go by, then probably tweaking or positioning your portfolio over the next 50-ish days, trying to guess or base those actions on who's going to take the office are not necessarily the wisest strategy. And I think the other data point I would just want to give is if we look back all the way since 1931, around 1931 to 1932, U.S. equities generated around 11% of returns 12 months after the conclusion of primaries. And if we compare the same period of time versus a non-election period, it's around 5 to 6%. So I would say that to supplement to what Chris said earlier on, just whoever takes the office, Again, if history is something that we want to base on, it really doesn't move or change the fact that equities would just trend higher.
Okay, it all sounds quite constructive. That's good. Maybe going to Andy, changing subjects a little bit. One thing that still is on a lot of clients' minds is that the kind of debt to GDP ratio, particularly in the US, continues to grow at some pretty shocking numbers. So, as a fixed income investor in particular, like how should we think about that? And I know it's maybe a little bit less relevant to Asia, but like still, it's a global issue that impacts Treasury as well.
Sure. I think that's definitely something increasingly will get attention and has been getting attention, particularly I think during whenever there's major volatility in the interest rate market. And it doesn't seem that near term there will be a solution. And it's because looking at both presidential candidates in the U.S., none of them is putting that as a priority. Looking at the fiscal policies, I think both sides suggesting quite a significant deficit to persist, both Harris and Trump. So, but if we look at the actual numbers, I think last year the debt to GDP is about 97%. It's already high, but it's not among the highest among the developed market countries. The concern is really the trajectory. So based on the current rates of fiscal deficit, roughly is adding like 2 to 3 percentage point every year. So I think it's assuming Trump and Harris are not going to do anything with that. So by the end of the presidential term, like 2029, that would rise to 115% area. So it still is like compared to other like developed markets, still okay. But the question is the trajectory, longer term, like 10 to 15 years from now. So we don't see that as a crisis in the near term, but the longer term concern we think is continue to linger, and that would, in terms of impact on the financial market, that would lead to, we think, a steeper yield curve, and that's also one of the reasons why we are a bit reluctant to take very long dated bond risk, whether it's 10 year, 30 year, but we'd rather stay at the shorter end of the yield curve. Yeah.
Got it. Anyone else have any thoughts on fiscal policy, or I mean, debt to GDP, or if not, we can go to the next question.
Yeah, so it's an interesting stat to look at. You have seen debt to GDP in the U.S. go down over the last few years. With respect to fiscal deficits, I think the challenge comes is when there's fiscal deficits and such, and an economic expansion. And that's kind of what we saw 2016, 2017. We saw that again towards the end of COVID. I think when fiscal deficits are used to spur demand, that's one thing. When it's used when the economy's already doing really well, that's where it becomes more challenging. And like Andy pointed out, fiscal restraint doesn't seem to be in the agenda of either candidate. Yeah. So let's see what happens there. But that's really where the key focus on our end and how we think about that issue.
Okay. In the interest of time, I'm going to probably address two more topics. One is going to be about kind of Asian markets. Clearly India and Japan have had a lot of attention, particularly as China, obviously going through a pretty difficult time, but also because Japan has seen, I guess, changes in governance, and there's been kind of the first quarter where we saw positive consumption growth, and India, obviously, the demographics are strong, and the growth outlook is strong, et cetera. So maybe, Andrew, you can give in the equity allocation as well. Is there, how should we position in Asia, if at all, in terms of within Asia? Because a lot of us are sitting in Asia as well.
Sure. So Japan and India, if we can start with Japan, I think I'm going to go through just what happened recently in Japan. I think the market, when we tried to digest the fact that BOJ started hiking rates, I think markets went a little bit ahead of itself, worrying too much about whether this policy normalization is going to be too quick, too soon. And I think that was why the market sort of reacted really in a negative way. I think, for me, I think the policy normalization, I expect it to be actually going to be quite gradual. And also, if you look at the latest narratives from policymakers, essentially this rate normalization is going to be dependent on inflation numbers, but also they are going to be looking at how that's going to impact the market and how markets going to impact the economic outlook, as well as prices. And so in terms of how I think about Japan going forward, it's whether this rate hike would be able to tame some of the import inflation, while on the other hand, real wages, can it really go higher in order to drive domestic demand and ultimately keep the domestic demand pool inflation? Because putting two and two together, that those are very important elements to sort of really drive the reflationary trend that we're starting to see in Japan, and that would ultimately help the economic growth, but also the equity markets in Japan. But I think, how we position in Japan, again, it's just focusing on individual companies. I think, we are a capital group. We're a bottom-up stock picker. Every year we do more than 21,000 company meetings around the world. And so assuming that there are 250 working days, we basically do more than 80 company meetings per day. And so I think ultimately you just have to find the right companies, because whether economy is doing well, whether economy it's, I won't say crashing and burning, but when the economy is not doing well, there will be companies that are the bright spot that would do well. So I think that's how we think about approaching companies from a bottom-up standpoint. And very quickly on India, I think from an external viewpoint, I think India definitely is a clear beneficiary of China Plus One strategy by a lot of companies. But also, I think domestically, there are a lot of exciting elements that really drive the secular growth trend in India going forward. One is reforms. I think reforms is a key driver for economic growth in Japan. We saw the nationwide GST reforms. We saw UPI, the Unified Payment Interface, as well as voluntary biometric identification system that essentially bring a big part of the population of India into the financial system, really help them generate more credit growth, and I think that's one. Infrastructure boom is real. Over the last 5 to 6 years, the Indian government have poured in billions in improving different areas of infrastructure, and that will help address the bottleneck. And I think finally, on going back to China Plus One, I think we've all heard that, well, right now India is actually producing Apple's iPhones. We see Japanese companies like Daikin Industries are going into India to source and produce their air conditioners and components. So I think the manufacturing capacity right now in India, the expansion trend is very closely associated to what has happened in China before. And I think that's definitely benefiting India in a structural term going forward. And so again, finding companies, we're trying to identify companies in sectors that would be able to benefit some of those growth trends that I just highlighted. So real estate, financials, or even in communication services are some of the spots that we're looking at.
Thank you. So moving on to Chris, I just want to add something to that, which is, this question of, is emerging markets finally gonna see some light at the end of the tunnel after 14 years? And people are saying, oh, rate cut means lower, US dollars, meaning more room for, rate cuts in other jurisdictions, outperformance, et cetera, et cetera. I mean, is this the time for emerging markets?
I think from a strategic asset allocation perspective, absolutely, right? You have the peak in US rates, you're going to see those rates go down. It's going to be a tailwind for emerging market currencies. If you think about what drives equity returns over a secular horizon, we think it's valuations, it's earnings growth, and it is yield. So it's really those three pieces which drive returns over a long period of time, and valuations and growth look attractive. And I'll take the hard one really quick. So China. So we're actually very constructive on China over a secular horizon. At the end of the day, China is still going to continue to grow from a real GDP perspective at twice the rate of the US. Much more attractive valuations. You're obviously going to need some catalysts, but if you are a strategic investor with a 5+ year time horizon, we think it's an essential component of your portfolio. So over a longer term, we absolutely think emerging markets is a place you want to be allocated to. I think once we get out of this more risk-off type environment that we're going to see over maybe the next few quarters, we think next year, maybe the second half of 2025 onward, could be a very good environment for EM equities and fixed income too.
Which is what I was going to go to Andy, EM fixed income. Could you give us a little bit more color on which areas in particular, like India bonds, for example? I mean, there's been a lot of interest there as well recently. But like China property as well, I'm sure that's a very difficult place. But generally, in emerging markets, how do you think about that?
Sure. I think for Asia fixed income, so one key trend is I think increasingly investors are taking more like an APEC approach. In the past, it's more like Asia, Japan, and then with a big portion in China. Like 3 years ago, China is like 40-50% of the Asian market. In the last 3 years, the Chinese hard currency market has shrunk quite a bit. So now it's only like 25% of the for example, the JP Morgan Asia Credit Index. So it has been quite a healthy development, I would say, in terms of Asia strategies from diversification and goes to more diversification across different countries. And Japan is one destination. I think I think Andrew covers quite some of the views on the policy outlook. We share similar views. We think the BOJ is going to take a more gradual, very careful approach in terms of further increase the rates. Our involvement is more on the Japanese hard currency market, the US dollar bond market. We like the financial sector. We think the higher rate in the local market will improve the net interest margin, and also will help the insurance companies as well in terms of the investment yield. So Japanese financials, including the major banks as well as the insurance companies, is one of the overweights in our Asia strategy. Moving to India, the macro backdrop is definitely quite favorable. We think the sovereign credit rating is on an upward trend. Right now it's low BBB rated. We expect it to be upgraded to mid BBB in the next 12 to 18 months, which will be in line with Philippines as well as Indonesia. And that will support the credit spread performance as well. But at this juncture, we think the valuation of the investment grade rated Indian bonds is a bit rich. The spread is already pricing in the rating upgrade story. We like some of the bottom-up stories in the high yield sector, particularly in renewable energy sector, in TMT, in some of the infrastructure credits as well. Yeah.
Yeah. So with that, I'm going to actually hand it over to the floor to ask some questions to our panelists. So if you have a question, I'll probably repeat the question. Anyone have any questions on the floor?
First one's always the hardest.
Don't be shy. This is a rare opportunity to have a equity specialist, multi-asset and fixed income all at the same time. Anyone?
Go.
Yes.
Well, there we too.
What's the catalyst for China look like?
China equities or bonds?
China equities or any
Okay, I'm gonna go to the person who said they were positive on it. So, what is the catalyst? The question was, what is the catalyst for China equities to perform?
Yeah, it's likely going to have to be policy driven. So those are the type of things we focus on. I mean, stocks can remain undervalued for very, very long periods of time, but there is going to have to be a policy catalyst. We think if you're willing to be a strategic investor in that asset class, you're going to receive that policy catalyst. It's hard to predict exactly when that's going to come, but ultimately there is conviction they want to drive interest and growth in their capital markets, and I think it all goes part and parcel with that having some accommodative policy.
So real estate, or it could be any like.
Yeah, I think there's general easing of financial conditions and stimulative activity. I know there's a lot of concerns with real estate and the like, so they have to balance that. But we do think at some point, kind of in the intermediate term, we will see some of that policy stimulus. Ideally, have that catalyst, and then some of those valuations can start to kind of manifest, and we can receive the returns from that asset class that we were accustomed to receiving from the mid 2000s till about 2015, 2016. Thank you. Great question.
Yes.
There's another one back there.
I think this gentleman was first. So.
There was been rotation out of tech stocks into low volatility stocks last few months. So do you feel that's going to continue, or is that going to rotate back to the growth?
Yeah, I'll repeat the question because I think recording can't hear it. So the question was, there's been a rotation out of growth equity and particularly tech stocks into low volatility, maybe value stocks as well. Do you think that'll continue, or do you think it'll go back to where it was before? Maybe Andrew, you can take it.
Yeah, great question, by the way. I think rotation is just part and parcel of equity market investing. If we can still recall, towards the end of July, rotation happens into the small mid caps space, and then it kind of just stopped right off the bat. So I think it's going back to the point that I made earlier on. It's the fact that we're starting to see earnings broadening out. Again, if we look back at the previous 5 quarters since 2023, earnings growth has been dominated by Max 7. But what has really changed starting from this quarter, the second quarter of this year, the earnings season is showing that that's no longer the case. It's no longer just a story of the Max 7 or the IT, AI related companies, but the other parts of the sectors are participating in that earnings growth. And also going back to on a geographic level, we're also seeing not just the US, but other parts of the market participating in that earnings broadening out. So I would say that at this point in time, it's really being diversified across the global opportunity set. And I think the concept of having a core position, it's something that really could work at this point in time, because as you pointed out, there's a rotation, and then we talked about rotation to this part of the market, to that part of the market. But having a core portfolio within your equity position means that there will be a certain part of your equity portfolio is going to do well at a certain point of the market cycle. But then when the cycle turns, there will also be another part of your portfolio that's going to do well to capture that different elements and different flavor in the market cycle. So I think being diversified and focusing on having a core portfolio could be one way to think about how you navigate this sort of rotations in the market.
Yeah, sure. So on the low vol quality piece, we need to think about why those types of equities are outperforming. It's really the deceleration-driven environment, right? So quality low vol, high margin companies, high ROE, typically internally funding their capital expenditures. So that's really why we've seen that rotation from really around mid-July timeframe. We think that'll last into Q1. It's really driven by the prevailing macroeconomic environment. So once growth expectations start to improve, the leading economic indicators start to improve, that's when we'll rotate down the cap space into value stocks and the like. So always think about it in the context of the macro backdrop.
My question is to position ourselves right now. After the election, is it the right time to buy or to invest in U.S. market, or especially maybe tech stocks?
Yeah, so the question was on, I guess it was on market timing, like when is the right time to buy US markets, particularly after elections? Is it next year? Sure. Anyone want to take a stab at this?
So yeah, like I mentioned earlier, we're always fully invested, and we think the risks of trying to market time are very high. One of our competitors, actually, JP Morgan, did a study, and they looked at market data from May of 2004 to May of 2024. And if you missed the 10 largest days in the market in terms of positive exposure, your annualized return goes from 10% into about 7%. So that's why we don't time the market. That's too risky. We might up risk and down risk in equities, but we're always going to have full exposure. We just think going in and out of cash, the chances of us getting that right, even as professional asset allocators, is very low. When we miss, we might miss big. So we're always going to stay fully invested because of that. So when investors ask me, when should I invest? I say, well, you should be invested now. You don't have to invest all today, but we'll follow a dollar cost averaging type approach. But just we wouldn't generally advocate having a lot of cash and then making kind of big moves back and forth just because the risk of that is too high.
Yeah, I've seen that data set as well and completely agree. But the other thing that I want to say is really it's never the wisest strategy to time the market. I think it's just really hard to time the market right. But I think if you think about investing in equities, it's a short-term volatile asset class. It's always either goes up or go down in a very short time frame. But if you allow yourself to step back and sort of extend that time horizon, if you look at the global equity market, there's only one way for the equity price to go. It's to go up. And so it's time in the market, not timing the market, that will let time be the friend of your investment journey. And that really helps, I would say, generate that long-term repeatable returns when investing in equity markets. So I think that would be one thing too.
Now, I'm just glad that both of you are talking about things that we talk about all the time. So I'm glad that someone else is talking about
We
it.
didn't even rehearse this.
Okay, any other questions? Yes?
Yeah, the question is for Andy. Actually, I want to know about the selection
Yeah, I'll repeat the question. So the question is to Andy, your selection criteria of your bonds, and particularly for low-rated securities, and for Asian high yields.
Sure. So Asian high yield. So firstly, from a top-down perspective, it has changed quite a lot in terms of the composition of the market. So the high yield China property was 35% of the market 3 years ago. Now with all the defaults and also repayments as well from some of the good companies, the sector has shrunk to roughly 8% of the market. And we are still very, very cautious on the remaining 8%. We think there probably would be like a couple of survivors, but the default rates in that particular segment will continue to be very, very high. So we are very, very careful in terms of having exposure in the China property sector. The criteria we're focusing on more like companies with recurring income, for example, rental income from shopping malls, which will help them to assess funding using the investment property. So that's China property, that's 8% of the market. For the remaining Chinese high yield market, the China non-property segment, which is about 16% of the market, so 8 plus 16, roughly China is about 24% of the market. But that 16% of the market, we're focusing much more on the ability to access funding, particularly in the onshore market. As you know, China has been cutting rates, and so for companies which are able to borrow money, the borrowing cost in the onshore market is actually much lower than if they raise money in the offshore market or including the US dollar bond market. So for those companies, we're seeing some cases they are raising cheap funding in the Chinese market and then use the money to buy better US dollar bonds. And we do expect there will be some more such cases. So we prefer those selective companies, and typically those would be ideally with some linkage to the government or some of the industry leaders in certain sectors. Outside of China, the remaining probably 76% of the market. Actually, if we look at the default rates I mentioned earlier, it's very, very healthy. In the past 10 years, average roughly 2%, which is lower than US high yield market. Last year, it was lower than the US high yield market. This year to date, we're running at 0.5% of the market. So broadly speaking, we're quite comfortable. We are cautious on a couple of industrial companies in Indonesia and India, and that is in our default rate forecast as well. But those are really the idiosyncratic cases. We prefer some of the double B, high single B part of the market, primarily focusing at the shorter end of the curve. Again, if we look at the broader credit market, whether it's high yield or investment grade, the credit spread term premium, meaning that the incremental compensation you're going to get by extending duration in credit is quite flat, which we think is unreasonable from a fundamental perspective. So we expect some steepening. Aside from the rate curve, the credit spread curve, we also expect some steepening as well. So in terms of credit selection, we prefer staying at the shorter end as well. Yeah.
So in the interest of time, maybe we'll take maybe one or two last questions. Yes.
Do you have an opinion on central bank digital currency?
I'm sorry, could you repeat the question?
Central bank digital currency. Do you have an opinion?
Oh, so the question was, do you have an opinion on central bank digital currencies?
Whether it's happening or not.
Yeah, I'm afraid none of the panelists here are experts on the digital currency side.
I could the traditional digital assets, and we have a framework for those in our portfolio. So think something like Bitcoin, but we don't necessarily have a policy view on whether those will come to fruition from like a CBDC perspective.
Thank you. Maybe one last question. Yes.
Do you think technology will companies will continue to go higher, like Nvidia?
Okay, I'll repeat the question and then I'll give one last gentleman because you had a question as well. So the question was on technology stocks. I think Andrew, you addressed the question a little bit before. Do we think these, as a sector, as a company, these will continue to move higher? Any thoughts?
Yeah, I don't have a crystal ball, so I can't tell you whether it will definitely go higher or not. But going back to what I said earlier on, if you look at the technology sectors, obviously there are a lot of different companies operating in different sort of sub-industries. But if you look at some of those big tech companies that's been driving market returns since last year, again, these are companies that obviously are trading at really stretched multiples, valuations, but to a certain extent, they are justified because they do have really strong moat, really strong balance sheet cash flow. But also, I think one element that's very unique for these companies, in addition to the winner takes all, winner takes most industry dynamics that they're operating in, is that a lot of them actually on the top line revenue is recurring. If you look at Microsoft, I think around 85% of their revenue is recurring through the subscription-based businesses. And I think that makes them in a very unique sweet spot because even if we're going to go through different points of the market cycle, their top line is relatively less cyclical because of that recurring revenue stream. And so I think there are definitely pockets of opportunities within the tech sector. Whether the tech sector would continue to go up or not, I don't know, but if you look at year to date, right, look at MSCI Agri, for instance, tech is actually not the best performing sector. It's actually the third best performing sector. And I think that shows that actually you have to click one down and look at the companies and find the right companies that are fundamentally attractive, have that long-term outlook that would justify the valuations and get into those positions. I think that would be how I think about it.
Thank you. Last question.
I don't really mind to divulge my age here, but I'd like to have your comment on the newly issued bond by the Hong Kong government.
Okay, the question was on a comment on the newly issued bond by the Hong Kong government. So I guess Andy's the only person who can
So I mean, Hong Kong is highly rated. So yeah, I mean, valuation, actually we don't have very, very, very strong view. I think it's priced in line with the credit rating. Mm-hmm. So we do expect a bit more supply. I think people here are familiar with the fiscal situation in Hong Kong. Mm-hmm. So when we position, we take that into consideration as well. In terms of supply risk in the future. Yeah. But as a whole, we're comfortable with the credit.
So before we end, I just like maybe have one last comment from each of you, just one takeaway, very short, that you'd like our clients to take away with tonight. Maybe Andy, since you have your mic.
Sure.
Could be about anything.
Yeah, I think I just sell my product. As I mentioned at the beginning, I think we reached an inflection point in terms of the monetary policy, and this is the right timing to at least have some exposure to bonds if you're underweight or don't have exposure. And bonds provide us with income and as well as potential capital upside, as well as serve a hedge to other risk exposure in the portfolio. And these features did not exist 2 years ago, but now bonds returning to its traditional role in a portfolio context. Whether it's soft landing, whether it's recession, we do think bonds provide good risk-adjusted reward at this juncture.
Okay, so bonds are back.
Yeah.
Chris?
I would say stay invested, don't overthink it. Think about what aligns with your long-term time horizon, financial objectives, goals. Both equities and fixed income can be excellent tools to help accomplish that. Multi-asset, which basically just blends the two, can be very flexible, align with your desired risk tolerance parameters, navigate markets while staying invested, and ultimately letting that do its work over a long period of time while you do your day job and enjoy your life and things like that.
Okay, stay invested with long-term goals. Andrew?
Yes, so for equities, volatility is just part of an equity investor. But I think there are a couple of things that are going to drive the equity markets over the medium to longer term. One is an interest rate cut environment. Second, it's earnings growth is back. And thirdly, there are just really exciting secular trends, AI, healthcare innovation, renewable energy. These are going to drive the equity markets going forward. And how to navigate a global equity investing going forward. One, it's adopting the approach of and not or, and also don't get too cute on timing the market. It's not timing the market, but time in the market that can help generate that great investment returns. And how do we do it? It's really through building that diversified, fundamentally driven stock selections portfolio. And I would think that ultimately sort of sums up that core concept when constructing your equity portfolio that we think over the longer term will be able to generate that great investment return sustainably.
So invest in diversified equities, don't time the markets. Great. So actually, one last comment from me. I mean, I think we've seen a very, very large inflow into money market funds and a lot of fixed deposits over the last few years. And understandably so, because these are considered largely risk-free assets that are giving you 4%, 5%, et cetera. So why not? But I think it's important to remember that even during that period, equities overall have actually done pretty well. So you look like you were in a really safe asset, but actually you weren't. And then as rate cuts will happen, inevitably, it'll be even more evident that fixed income, for example, outperforms cash. And then equities generally over the long run tends to, because they're a reflection of the GDP growth globally anyway, that it is good to stay invested, diversified, goal driven. So I encourage all of you to try and stick to this plan, use Endowus for it. But thank you all of you for being in this panel today. It's been very, very helpful. Thank you very much.
Thank you.